Hi, and welcome back to the European VC, the go-to podcast for everything European VC. If you love the show, share it with your friends and join our newsletter at eu.vc. Today, we're happy to welcome Jean, President and Managing Partner at Ventech. He joined the company in 2000, acting as a facilitator of the Partners Committee, defining Ventech's global development strategy, and is a veteran driving investments notably in hardware and communications. If you enjoy our content, do support us by hitting the follow button, giving us a review, and following the European VC on LinkedIn.
Jean, welcome to the European VC podcast. Super cool to have you here. How are you today?
I would love to say that I'm super fine, but I'm at the end of a small COVID experience. So I'm getting better, but thank you for asking.
Listen, we wish you a speedy recovery. I am probably in a similar situation to you, so I might have to mute myself to clean up my throat a bit in the next recording. But I think we're both recovering, and that's what matters. So all good. Jean, before we deep dive into topics, I always like to start with the same question, which is kind of what made you and the firm kind of exist. What is the origin story? What is the backstage details that few know about Jean and Ventech? Do share.
Well, I think we are part of the pioneering wave that entered that European venture capital market in the late 90s, very early 2000s. So the landscape was very different then. It was really a nascent ecosystem with very few entrepreneurs, very few, even fewer repeat entrepreneurs, and a level of ambition that was very different from what it is today. Was the thing that we were feeling a bit doomed, to be dominated by the US guys and stuff. And at that time, one of my historical partners, Alain Caffi, he had been doing all kind of things in private equity during the late 80s and the 90s, including a bit of venture in the late 80s, which was absolutely crazy. And then was like, there's no market, so we need to do something else. And he said, it's time to get back on that. And that's how we met. On my side, I was a sales executive in the telecom and semiconductor industry, and I created a small subsidiary of a technology consulting group dedicated to do due diligence for private equity investors. So remember in '99, so everybody wanted to do tech, and nobody had a clue of what it was. So we were consultants, created that small outfit, and that's how I met with Alain and Eric, who are still my partners 22 years later, and decided to join them in that adventure. So we were lucky enough to have the sponsorship of a bank at that time, which was the Natixis Bank. And so they clearly helped us two ways. To start our European operation, obviously, they were at that time chipping in something like 30% of the funds, which is massive. I mean, you begin with a 30% corner investor. It's a game changer in the industry. And then after that, when we had our first, venture outside of our initial market, which was Paris, they helped us set up an operation in China. So that was in 2007, 2008, by providing the seed capital to open the Ventech China initiative. And so today we walk on three legs. So Ventech, as maybe some of your listeners know it in Europe, Ventech China, which is a sister company with 15 people in Shanghai and Hong Kong, and operating a different family of funds and investing in early stage in China and Southeast Asia. And we have a third strategy, which is called Alliance for Venture, and which is a seed fund dedicated to impact companies. So that's how we were born, and then we became fully independent roughly 10 years after that. When the financial crisis hit in 2008, all of a sudden the bank guys said, "Ooh, this is not for us. That business is not for us anymore. Please leave without us." And fortunately enough, we were mature enough to live our life without them.
Jean, I have to ask this because I think it's such a timely topic to some extent, which is, would you be willing to share some details about that process of becoming independent, and what were the challenges that you as a firm went through at that time? Because that must have been, I can only imagine, a challenging period in terms of thinking about the future, of also where are you gonna get that money that you're getting from this big LP? Like all of those dynamics. I'd love to hear what you can share with us.
Yeah, well, there will be nothing, no bad stories to tell. So sorry for the buzz, but I must say that we had a sponsor that was near perfection in every aspect. And so what happened in 2008 is that it's no secret that Natixis went really close to bankruptcy, as a bank. And so they decided to cut into anything that was hitting their ratios in terms of solvency and everything. And obviously private equity, when you're facing with short-term issues, private equity is not a good place to be, right? So they told us, we won't be there for the future. We're going to split out. We were co-shareholders of the management company with them, and they just let us go with the management company. I have to say that we're not raising big funds, so the management company has never been like a cash cow that had any significance for a bank like Natixis. So that was not an issue for them, and they just told us, sorry guys, we're not going to be in your next funds. And by the way, we kept very good relationships with the group, and so there are other arms of the group that are LPs in our fund today. So it was very smooth, actually.
It's funny. We had another guest, a Portuguese guest, and I see from Andrea's face he was going to talk about that. We had another guest that was also very much bank sponsored, so to speak, and also at that time similar issues. Right? No need to explain because you just did. But in that case, they actually had to set up a secondaries transaction to buy back what was owned by the bank, which is extremely interesting as a story, but also a much more challenging story than the one you shared, which is really interesting. Andreas, did you want to ask or say anything on that regard?
Yes, so Jean, I'd ask, it's obviously a long time ago, but I'd love to hear if you have some learnings, because there are many who get started in VC in the corporate sector, in CVCs, and then, typically or oftentimes these projects don't go too well, and then you want to spin out either as your own, or you actually want to buy out what's there already. And I'd be curious to hear, if you have some learnings as to how to navigate this, how do you ensure a good relationship with the senior leadership for whenever that time should come?
Yeah.
What are core things?
I have two key learnings, very, very simple and very clear. The first one is, who's your LP base, right? So the Natixis was 30% of the fund. 30% is not 100%. It makes a huge difference, right? And as far as I can remember, in times like 2006 or something like that, was when the market was thriving. The guys at Natixis told us, hey, you're losing so much time raising money from the outside. We are underexposed in the venture marketplace. You're looking for 150 million. We can put the whole 150 million. And we said no. We said, this is painful. Yeah. It is difficult to raise funds, especially because we were very French at that time, and the French ecosystem of LPs is definitely not deep for the lack of long resources. But that was a very strong belief on our side that would say, no, we think that raising money from multiple sources is a guarantee for many things. It's a guarantee for perennity. It's a guarantee for discipline and everything. So that was a lifesaver, obviously. And second, we had a shareholder agreement. I personally spent weeks and weeks negotiating that shareholder agreement of what happens if we decide not to continue together. And so trying to make it balanced in the sense that the sponsor was committed to put 30% of every fund, and they had some perks related to that. So a part of the carried interest and stuff like that. And we were committed to accept that money and to continue to collaborate. And so there was a whole set of mechanics of how to unfold that if one of the parties was not to respect this commitment. I would say it was basically all written, black and white when we decided to split. But the most important thing is the first one. If you refer to corporate VC, and most of the corporate VC, it's a single LP thing, and they're putting 100% of the money. What can you do? I mean, you're just starting from scratch, right? You can argue to other LPs and do a full-fledged fundraising and say, we've been working together for a long time, we know each other, we have that track record, blah blah blah. But you're basically starting from scratch.
I remember a conversation with a manager that was in that situation and was trying to figure out, how do I best navigate this and maintaining my integrity and not doing anything that my single LP that I've always been happy about and so on and so forth. But the relationship was kind of cooling. Their interest was getting lower and lower. They needed to do other things, blah blah. He wanted to continue, and then figuring out how to do that with a single LP without stepping on any toes. Just when out there testing is a relationship management deal that is not easily accomplished.
If you think about, so we went down that route also when we launched China. We launched it with a single LP. It was $25 million from the Texas, right? And that's it. And at the end of the day, a single LP is not an LP. It's just a commitment that the investment committee will look at the deals that you bring. That's it. Nothing happens if they say, oh, by the way, did I tell you I put 100 million? I'm going to stop. What happens? Nothing, right? When you have multiple LPs, then you have a default procedure and you lose your money and stuff like that. But if you're a single LP, there's no default. So I very much remember when we were negotiating that credit line, so to say, to launch Ventech China, we said, these are the intentions. We're going to put 25 million US to work, and we could make it up to 50 or in certain conditions, blah blah blah. But at the end of the day, the only thing that was a commitment was to say for 3 years we will allocate. I don't remember the number, but maybe 1.5 million or $2 million of budget for the management company, and this is the firm commitment.
Yeah.
But that's the only commitment that they take. The rest is, you bring your deal to whatever investment committee it is, and they say yes or they say no.
Yeah, so you're much more exposed to the whim of the executive branch when you have a single LP, absolutely.
And the thing about, CVC is a difficult animal because you have to marry the cycles, right? And we're long-term people, especially when you're doing early stage. So you have to think 10 years ahead, and it's very difficult for a corporate. So a few markets, they have that built in. I think it's no mystery why the life science corporate VCs are working really well. It's because they think 15 years ahead. It's no mystery why Intel Capital has been here for always. I mean, the semiconductor roadmap is here already for the next 30 years. Right? But when it comes to telecom operator or whoever,
let's use bank as an example, right? Where the hell is DeFi going to go?
yeah, exactly. Maybe 1 year after launching, the priorities can change. The people can change. No one in a corporate with someone super talented in a big corporate and ambitious will not remain 10 years in the same spot. So all of these are real issues on corporate VC. Now you have a few exceptions. If you're Google Venture, anyway, you can throw 300 million at anything because it's this or paying new buses or a new cafeteria or who cares? But for a normal corporate, it's a difficult thing.
I just have to ask you, but I do want to shift to China very quickly. I've always had the thought, I wonder why universities and corporates don't do more CLP rather than CVC. If you're a big LP or at least significant LP and you do bring value to the VC and engage with the VC in a meaningful manner, then there's quite a bit of value to get out of it. And in the end, most corporates don't know how to work with a startup well enough to really be able to work with an early stage startup efficiently. So having that direct relationship through the CVC might not even translate into something valuable. Whereas a CLP would give you the overall understanding of what's going on through the VC. And then, if there's actual business to be made, the VC will ensure that you can, of course, access the startup, but it's going to be arm's length. And that's, you want to be at arm's length for everyone to not be hurt by the relationship.
It's the current trend, right? And the corporates who want to have a bit of exposure, they're becoming LPs in some funds. Then you have a lot of things that you have to think about, how real is the commitment? I mean, if you're Airbus and you're putting 5 million in the fund, are you committed to anything? But they're trying to. And usually it comes with the will of a couple of people on the innovation branch who want to have a better knowledge and better intimacy with the startup world and stuff like that. So I think it's happening. There are lots of difficult things to handle. Are we equipped as VCs to handle that kind of relationships? It's difficult if you want to spend the time. We've seen a few of our fellow VCs in Paris having a collection of like 10 or 12 corporates in their funds. It's a mystery to me of how they manage to maintain a valuable relationship with 10 to 12 corporates. Most likely on the innovation side of things, any one of that 12 can throw more people than you have in your whole team. I don't know.
And it's also, I also find it interesting because the average tenure of these innovation directors and all of those roles is actually really small. They don't tend to stay for long. And that's also, I think, a huge challenge for any VC trying to work with corporate, especially when the budget's coming from the innovation department or marketing or whatever, instead of coming directly from the headquarters.
Maybe it's just a matter of time, right? And people will find their stuff. Again, if we take the life science example, the collaboration between the startup worlds and the big pharma is super mature. But it comes with the fact that these guys, they don't hesitate to throw big checks around for the winners, and so it makes it a valuable relationship for everyone.
Okay, so now let's shift to the topic of China, because I think it is, honestly, we hear all the time about VCs in Europe that have very strong ties to the US,
Yeah.
And have built a company or a firm with presence both in Europe and in the US.
Yep.
But you've built a company with presence in Europe and in China.
Yeah.
Take us through that thought process. Why did you gravitate towards China? And what is it that you've built? Let's start there, and then we can unpack, because I think there's a lot to talk about.
Yeah. I think it also comes on the back of one strong belief, that is, if you're not doing deals, I mean, we're venture capitalists, so our core business is to do deals, right? It's not to help companies doing biz dev in California. So if you're not doing deals, you're not on the map. You are non-existent. And so if we were to say, hey, I'm sending someone to Silicon Valley or to New York to represent my firm, but not doing deals, either I send a young resource who will be happy to do that, but I mean, what are the odds that they strike great deals with Verizon, right? Or I send a senior partner, and then he's going to get bored like hell. So he or she, sorry.
Unless he takes up surfing.
Yeah, exactly. But that was not my plan. So so we think you have to be able to be a valuable deal maker, and to have a credible access to premium deal flow, right? And so that's, in any expansion that we've done, it was always the thing that we wanted to check. So we've done it in Europe, and I guess we'll touch upon that, or why we expanded into Germany and the Nordics. But in China, it was very simple. In 2000, I think beginning of 2006, one of my partners, Alain, took a trip to China with the French Association of Private Equity. He said, I haven't been to China in like 10 years. I'm going to allocate that for those 4 days and stuff. He came back and he said, I didn't recognize Shanghai. I didn't recognize anything. It's just absolutely crazy. We have to do something. I have no idea what, but we have to do something. And so we started. He's the creative of the three, right? And we started out by hiring a guy, just to explore the market and see if we could do stuff for our companies. But so exactly what I said, I don't want to send someone to do, but we hired a consultant, right? And just to explore. And after that, so we tried to gather a bit of money. And as I said, Texas was kind enough to provide that money. And we launched a year and a half later, because we thought something's happening there that is once in a lifetime, really unbelievable. And there's room. I mean, you had a few California funds already there. So IDGVC was super strong, Matrix was strong, Sequoia was starting, Kleiner Perkins also, and a few local players, but really not much, and that's it. And so we launched, and we managed to do deals and to get a few deals. I think we had 4 IPOs on NASDAQ or so in the initial 6 or 7 years, and so it did put us on the map. So as simple as that. But you have to have some room. If I always, some of the LPs, they ask us, why don't you go and do deals in California? And I say, do you talk to a chef in Kentucky and say, why don't you open a restaurant in Paris? Right? I mean, man, nobody's waiting for us in California. So if we have an angle, a specific angle, why not? But if you just go there, be a generalist VC and say, hey, I'm going to be around, what's the point? There's one European guy who managed to do that. That's Index. But they had already strong ties, brilliant guys, and they suffered. I mean, I remember in the beginning going to San Francisco to see Index, and they were like saying, oh, it's strange, because in Europe we're a bit they're humble, so they were not saying it like that. But my understanding was that in Europe we're a bit the stars of the market, and here we're just like, ooh, those guys are around also.
Yeah,
I think that has
super interesting.
I think that has changed, by the way.
Yeah, for Index. But not the reality of the market. I think that's a very good perspective, and one that's overlooked a bit. We skipped a little bit the size of your activities in China. Could you just go a bit more into detail on that? Because you said you want to be an active and relevant deal maker in the region. How do you fit in China? What's the ecosystem like? I'd love to hear that.
We have a 15-people team mostly in Shanghai and a bit in Hong Kong. So we're doing 80% PRC, so People Republic of China, and 20% Southeast Asia, mostly Indonesia and Singapore. We're doing seed and Series A, mostly focused on lifestyle. How do you equip the 30 to 40 million Chinese people that access to the middle class every year? so which is about building a new France every 2 years. So I mean, that's a bit of business traction, right? So that's basically it. And we raised so Fund 4 is equivalent of 130 million US.
Yeah.
We have half and half US dollars and RMBs.
And is it dedicated to China,
Yeah.
that fund for, or is it global?
Yeah. So the way we function is that we have those three families of funds that I mentioned. So the new kid on the block is the impact fund. So we raised that last year. Then we have the flagship historical fund, which is the European fund. And then in China, we raised Fund 4 in the first part of 2022. And the way we do it is that the decision making is separate. I don't have a vote in the investment committee of Ventech China. Because we think it's too far away, and you need the exposure to the market, you need the exposure to the founders. But we have a weekly video call to collaborate on deal flow and due diligence and potential collaborations between the two portfolios. So we maintain very close links, but we don't want to interfere with the deal making.
You're obviously not Mr. China, but and you're drinking from your Great Britain cup, which has me laughing a bit here. But tell me, navigating China as as an investor, policy wise, and the whole, it's a different
it's very,
place in the world, right?
It's very different. But first thing first, it's a very different situation now than what it was 15 years ago when we started. So the Chinese internet is more separated from the Western internet today than it was in 10 or 15 years ago. And obviously, I mean, the tensions are at a different level. But our team is Chinese. So with the exception of one of my historical partners who relocated there in 2008 and who still heads Ventech China, who's European, all the rest of the team is born and raised in China, which is super important if you want to do early stage deals in the region. It's different patterns, different risks, different pros, different cons. I think the big pros in China, and maybe after that we can go back to Europe if you want, but the big pros in China is huge TAM and incredible ability to scale and to reach profitability. The huge con is exit is always complex. Always. There's no M&A market. The IPO market is now a bit in limbo. You don't go to the US anymore. Hong Kong is not yet up to speed. Shanghai is nowhere. So you have great assets, great figures, and for the moment there's a lot of work to rebuild the exit market.
Before we got excited about topics and we ran a bit crazy and derailed the whole script. But I really want to give you the opportunity, John, to talk a bit about your partnership model, because I'm literally looking at my second screen here and I have Ventech's locations open, and it's amazing, right? What you guys have built, it's really cool. It's super inspiring. But I think it's probably very much connected to that distributed partnership model. So tell us a bit about it. Give us the quick rundown, and then we can get back on track with the script.
Yeah, thanks. So the main decision that we made 12 years ago or something was, when we were well established as mostly a French player, doing a couple of deals here and there around France, but mostly a French player, and wanted to expand. You can't stay still in our business, like in any business. So we wanted to do more, and RLPs were asking like, do you want to do growth? And we said, we gave it a lot of thought and said no. It's a totally different business for us. It's about analyzing assets rather than analyzing vision and founding teams. And it's a different shape of company in my view. In a growth fund, you have a few senior partners, and then you have a lot of maybe more junior people constantly screening the market and getting updates and getting the numbers and stuff like blah, blah, blah. This is not what we do. So we decided to remain a pure early stage investor. We built a partnership that is made for that, with all senior partners. Everybody in the partnership has more than 10 years in VC, and sits on the board and do the due diligence and do the deal. So we do everything ourselves, right? This is the benchmark model, so to say, if I had to pick a role model. And so we said, but what we're going to do is that we're going to expand internationally, because it will enhance our benchmarking capacity, and it will allow us to do great deals in other geographies. When we started in 2013, the obvious place to go was Germany. It was underserved, big market, great entrepreneurs, totally underserved in VC at that time. And we had a long-time friend of ours who was ready to join. So we launched Germany, and we're very happy about that. We now have 3 full deal makers in Germany, Berlin and Munich, and doing great progress on that. And then we said, this is just great. I mean, the playbook is great. We want to do it again. And we said, where do we go from there? And so basically you had the choice. If you take France is 20%, roughly 20% of the US of the European market, Germany is 20% of the European market. Then you have London, 40% of the market, and then you have the Nordics, another 20%. And so we said, okay, do we have credibility to be in London, which is probably the most competitive market these days? And do we have a specific angle? And we said, no, but there's a low-hanging fruit that's here for us, which is the Nordics, which has proven for the past 10 years or 15 years that it was overperforming all of Europe in terms of value creation. And interestingly enough, there's a lot of people going there for Series B and C, and there are a few excellent local players at early stage, but no one has set up shop from the outside as an early stage investor in the Nordics. And so we started that, and we met with all the founders, all the VCs, and said, let's go invest with you. Let's go lead with you. We're going to bring stuff that you don't have, and we're not pure competitors, so it's going to be great. And we're super happy. We started that end of 2016. We established in Helsinki because there was a senior partner who we wanted to work with. But we've done deals in Sweden, in Finland, in Denmark, and we're very excited about that. Actually, maybe the best deal of our Ventech 5 portfolios in Denmark. Company called VO Technology. If you should have a look.
Yeah.
It's just it's fantastic. And actually we thought that the market in the Nordics is very interesting. I mean, the deal flow quantity is not huge, but the average quality is just great.
To our listeners, Andreas did a little smirk and smile when he heard that. When he heard that.
I was about to say that we have in Denmark, and I think it actually permeates most of the Nordics. We have a saying that is called the law of Jante, which is don't believe you're anything. And I think that leads only the very best founders to actually believe you can build something amazing. So that explains a bit the lack of breadth in deal flow, but also the quality of the ones that actually.
That's interesting. It used to be like that in France, and then from 5 years earlier, it's now everybody wants to start a company, which is good also.
Yeah, well, I think we do have that as well, right? But I think that that's something that's taken over all of Europe, and every young person thinks that they should be entrepreneurs and they should raise venture capital for their cornerstone bakery or something like that. You don't have to. But I do think that there is something to the culture that is instilled in people from a very early age, that even though that there's a superficial trend going on that makes people think that they should do that kind of thing.
Yeah.
I think it still keeps Denmark or Danish people in the mindset of being quite self-critical.
With the current setup, we're super happy. The reason why we talk about that distributed partnership is because we try to avoid at all costs to build a partnership with a super strong headquarter in Paris and satellite offices where people are not empowered enough. Because again, talent is the most important thing in our view. So if you send a principal in Berlin and that he or she shakes hands with the founder saying, yeah, I'm going to bring your deal to the investment committee, to the partnership, and we're going to do it. I love your deal, blah blah blah. And the partnership says no once, says no twice. Then if you have talented people say, okay, fair enough, I'm out of this. So we need local partners totally empowered, and that's what we do. That can speak for the partnership, and hence senior partners. And when I say senior is not about the age. I don't care about the age. So we have partners in our firm, equal GPs between 34 years old and 58 years old. I don't really care. It's about the experience.
And I was about to ask you if you could expand a bit on when you say empowerment, right? Because empowerment means many, we've all been taught that we need to think about empowerment. And then when you get into the details, there's very different perspectives on what empowerment means.
Well, it's pretty simple. It's a totally flat partnership. You bring and take the same, whether you're in Paris, Helsinki, Berlin, or Munich. So you convince the partnership, and then you speak for the partnership, and that's it. But you come with the same credit. And you come with the same credit if you're in your 30s or in your 50s.
And to anyone listening here thinking that this sounds cool and interesting to dive a bit deeper on, then we actually had one of your co-partners on the show and had a long conversation about exactly how she grew up inside the firm and why she chose to be loyal to the firm rather than jumping to another one, because that's typically what we see in VC. So I think that we've got an interesting combination there with you saying, from founder / top leadership perspective, how you thought about building it, and then we've got her take on
for sure.
on it from the other side, right?
Thanks. Proof of the pudding.
And you guys can find it if you're listening in and interested. You can find it on Spotify, Apple Podcasts, whatever. Moving on, we ran a bit over time, and that's all good because we're having fun. We're going to go into the quick fire, Jean, and that is how we love to end our episodes. That is quick answer questions, 30 to 60 seconds each. Are you ready?
Yep, I am.
The first question is, what areas, sectors, or technologies excite you the most, but that you don't find people around you getting that excited about?
The second part of the question is tricky. I think we're very excited about the transition to the cloud, and we think that we only see the beginning of all the tools and all the technologies that will enable the big corporations to move to the cloud. There's a massive opportunity in cybersecurity. There's a massive opportunity in performance management, and all things like that. We don't shy away when it comes to deep tech investments, right? So that's it. And to be a bit controversial, I'm a big fan of Web3 and NFTs and crypto and stuff. And I think I've lived through the 99-2000 crisis, and that was very similar. So I kept saying people last year, oh, this is 99 all over again, and it means two things. First is, do not spend all your money now, because 95% of it will be burned. But it's time to work hard on understanding what's happening, because I deeply think that it's here for 20 years. And all the guys that said in 2001, 2, 3, I don't want to touch that e-commerce or web thing again.
That's very cool that you say that. You almost answered my second question. I'm going to ask it anyway because I do think it's worth highlighting. The second question of the quick fire is, what are your top tips for emerging VCs across Europe who are now fundraising?
Number one tip is keep faith. Fundraising is a very unfair process. When you're an emerging VC, either you come with an established track record because you are a new combination of existing GPs, working together or not, and that's fine because there's a common view amongst LPs that those are very valuable combinations. So that's cool. If you're not, if you're new in that business, I think you have to have an angle, a specific angle. Otherwise, if you just go there and say I'm a generous VC, it's too hard. So you need to have a specific angle, and you need to understand that with a specific angle comes a higher risk.
I love that.
So that's it.
Secret sauce and risk profile. I love that. Finally, the third and last question, Jean, what has been your most counterintuitive learning since you started Ventech 22 years ago or so?
I don't know if it's counterintuitive, but the thing I think you have to learn when you come into that business of being a VC after being an executive in the industry, which is counterintuitive when you join, is to know when to stop. Because as an executive, you're compensated all your life to fix things that are not going well, and to never give up unless corporate tells you this week we drop. In VC, do not spend any time trying to fix something that is not working. You cannot lose more than one time your money. That's the rule. Rather than wondering how do I get 50 cents on the dollar rather than 30 cents on the dollar, concentrate on how do I get 15x rather than 10x. Learn to say, oh, not working, not going to fix it, sorry. And by the way, I always tell the entrepreneurs, at least the mature ones, because for the young ones it's more difficult to hear, to say, do not yourself spend 10 years trying to fix something that's not working. You maybe have 20, 25 years in your prime as an entrepreneur. Do not waste 10 of them fixing something that's not working. Find a buyer, find a home for your venture. It's good for employees, it's good for customers, it's good for the product. Even at very low price, who cares? And move, do something else.
Jean, I have loved this conversation. Thanks so much for joining us on the European VC podcast. We will always want to welcome you from the Ventech team back on the podcast. So thanks a million for joining.
Thank you very much, and thanks for your great efforts to make our business more well known to the community.
Thank you for listening to this episode of the European VC, the go-to podcast for everything European VC. If you love the show, share it with your friends and join our newsletter at eu.vc.